started with the live stream. I'll just start the recording.
Good afternoon, everybody.
Good afternoon to everyone. I, on behalf of the BRICS Chamber of Commerce and Industry, take utmost pleasure to welcome you all to the digital seminar on Union Budget 2022 and its impact on key industries, organized by the Direct Tax and Indirect Tax Vertical BRICS CCI in association with Avinav Consulting and JK Risk Managers and Insurance Brokers Limited. The BRICS Chamber of Commerce and Industry is a parent organization that promotes commerce and industry in the BRICS nations. The Chamber, founded in 2012, is a registered body under Societies Registration Act 1860, empaneled with Niti Aayog and recognized by the United Nations. India's economic growth in the current year is estimated to be 9.2%, highest among all large economies. The overall sharp rebound and recovery of the economy from the adverse effects of the pandemic is reflective of our country's strong resilience. This was stated by Union Minister for Finance and Corporate Affairs, Srimati Nirmala Sitharaman, while presenting the Union Budget in the Parliament recently. She also stated that India is celebrating Azadi Ka Amrit Mahotsav and it has entered into Amrit Kal, the 25-year-long lead up to India at 100. The government aims to attain the vision of Prime Minister outlined in his Independence Day address. Keeping this in mind, we at BRICS CCI are extremely delighted to present to you a digital seminar on Union Budget 2022 and its impact on key industries. I would now like to request Mr. Ruhail Ranjan, Member Governing Body BRICS CCI, to deliver the welcome address. Over to you, sir.
Thank you, Suzanne. I hope I am audible.
Yes, sir, you are audible, sir.
So, good afternoon to everyone. On behalf of BRICS Chamber and Commerce and Industry, we take utmost pleasure to welcome you all to this digital seminar on post-Union Budget 2022 and 23 and its impact on key industries organized by Direct Tax and Indirect Tax Vertical, BRICS CCI in association with Avinav Consulting and JK Insurance Brokers. The BRICS Chamber of Commerce and Industry is a parent organization that promotes commerce and industry in the BRICS nations. The Chamber was founded in 2012, is a registered body under Societies Registration Act 1860, empaneled with Niti Aayog and recognized by United Nations, with a focus on 4 pillars of development, which are inclusive development, productivity enhancement, energy transition, and climate action. The budget gives a blueprint of the economy from India at 75 to India at 100. The Union Budget aids in controlling the economic fluctuations as well. It ensures proper handling of inflation and deflation, thus bringing about economic stability. During inflation, surplus budget policies are implemented, while deficit budget policies are revised during deflation. This aids in maintaining a price stability in the economy. It also dictates the possible changes in the direct and indirect taxes of the country and income tax rates and tax brackets. Given the immensity of the COVID-19 pandemic, Union Budget 2022 had huge gaps to fulfill. We at BRICS CCI hope to have a very strong, interesting session on the aftermath of the budget recently presented. The session aims to discuss the recent developments in Budget 2022 as announced and how the different sectors shall be affected because of the same. Without further ado, I wish all the speakers and moderators and participants the best for the day. Thank you.
Thank you so much, sir, for such an insightful address and a wonderful start of today's seminar. Without any further delay, I would like to introduce you to our speakers for the first panel, which is discussion on income tax proposals. We have with us Ms. Nidhi Goyal. She's the managing partner of Avinav Consulting, which is handling multinational companies and outsourcing function in advisory and compliance. She is an experienced managing director with a demonstrated history of working in the accounting industry, along with skill tax, management, leadership, and consulting. Apart from this, she is a strong accounting professional who graduated from FCA MBA. We have with us Mr. Pranchu Goyal, who is a member of Institute of Chartered Accountants of India and a law graduate. Mr. Pranchu has a considerable experience in advising large corporate houses and high net worth individuals on a variety of tax matters. He has also represented clients in tax litigation and prosecution matters before appellate forums. And we have with us Mr. Saurabh Baser, who is an experienced chartered accountant with a demonstrated history of working in the taxation and accounting consulting firms. He is also the partner of indirect tax practice at JC and Associates LLP. And we have with us Mr. Prakash Sinha, who is an esteemed member of BRICS CCI and is also a reputed professional in the chartered accountant industry. He is also the partner at Prakash Sachin & Co. Chartered Accountants. I would also like to offer my sincerest thanks to all the participants who are a part of today's insightful webinar. Participants who are wishing to ask questions can drop them at our chat box. Without further ado, I would now like to request Ms. Nidhi Goyal to take over.
Yeah, thank you so much. And thank you, Rohil, for the introduction and the clarity on the economic side. I just want to maybe add here that India's fiscal banking culture and civilization are not only the only ones in Asia, but likely in the whole world. That's what is estimated or expected in this budget. And India's economic growth in the current year is estimated at 9.2%, which will be highest among all the large economies. So that's an encouraging statement in the Indian economic survey this time. Towards implementation of new public sector enterprise policy, strategic transfer of ownerships of Air India has been completed. And there is lot many other changes in the industry which has happened, like public issue of LIC has been expected shortly. Similarly, there are other privatization or public sector enterprises have been formed. Introduction of central bank digital currency will give a big boost to the digital economy, and it is proposed to introduce digital rupee having blockchain and other technologies to be issued by RBI starting 2022-23. So if you have seen in this budget, there has been talked about virtual digital asset, digital currency, and also it seems that it is going to be part of our economy, and our RBI system will definitely going to work on towards that separate currency which will be introduced. And that's how the income tax has initiated by introducing these sections. Maybe it was preliminary, or it was too early to be introduced in this budget, but I think they were proactive now this time to consider digital assets before even introduction by RBI. So in this budget, we have seen lots of changes, as Rohil has mentioned, about the pillars and certain areas, which is PM Gati Shakti approach this time. And apart from those areas of infrastructure, mobility, and of course, ropeways, they have introduced quite new things in this budget. This time, the thrust of the tax budget is to promote voluntary compliance by taxpayer and reduce litigation. So as we have seen in the previous budgets also, so mostly the changes have come after just to eliminate litigation on certain areas. It may not be favorable to the assessee, but it might be favorable to the department. But at the same time, the changes have come up in the tax, and then less and less changes are coming in the budget, and more introductions is coming towards changing the entire tax system or corporate tax system in India. So out of the many changes in this, so there will be certain aspects which our panelists will be covering. So we have Mr. Prakash Sinha, Mr. Pranchu Goyal, and Mr. Saurabh Baer, who is going to cover many of the important sections in the income tax, and I'll be also helping them in certain areas. Yeah, so Pranchu, you would like to take over?
Yeah, thank you, Nidhi. Thank you so much for setting the tone for today's discussion. And as you rightly said, that this budget is moving in a good direction, and it sets the path for a good economy for India. And soon we would again regain this tag of Sone ki Chidiya, I feel, as said by our PM. So yes, the budget, when it started, when our learned finance minister started the budget speech, we all were very excited. The announcement she made in EVs, drone area, infrastructure investments, etc. But the moment we read the fine print of the finance bill, and I personally read the fine print of the finance bill, I personally think that apart from very few amendments pertaining to virtual digital assets, updated return, and few others, mostly this finance bill is either rectifying the mistakes which were done in earlier finance acts or is unsettling the settled positions of law. Because either there are certain decisions by Honorable Supreme Court or Honorable High Court which have gone against the department and they have brought in amendments to unsettle that position. Apart from that, there are not much changes as such in the budget or in the finance bill, so to say. Furthermore, the finance bill also is complicating a lot of things at the same time. There are a lot of amendments, there are a lot of explanations being added. And the way it is drafted, the language in which it is drafted, there are a lot of loopholes and there is a lot of scope of litigation. So I'm hopeful. At various other forums, we are also discussing the same, and I'm hopeful when the final finance bill would be presented and it would be converted into Finance Act, then hopefully all these issues would be taken care of. To start with today's discussion, we have taken out few major amendments which are proposed in this finance bill. So we would be discussing about virtual digital asset, the concept of updated returns, and then there is another withholding tax which is introduced during this year. So every year we are seeing some new withholding taxes being introduced in guise of tax compliance. Suzanne, can you mute everyone else, please? Yeah, so to start with, we'll take care of, or we'll start with virtual digital assets amendment. This is one of the hot debated issue during this whole session once the finance bill came out and when finance minister announced that a certain tax would be levied on virtual digital assets. So 4 or 5 sections are introduced in this finance bill. So one is section 2, subsection 47, capital A. Another is section 115, BBH. The third one is of withholding, which is section 194S. And then one amendment is also made under section 56 to sub clause 10, which is of other sources. So whole in whole, all these 4 amendments, if you read collectively, pertains to virtual digital assets, the taxation of virtual digital assets, what are virtual digital assets, etc. So what is virtual digital asset? It is defined under section 2, subsection 47, capital A of the finance bill. So if you read the language of virtual digital asset, which is now being presented, it is very, very, very large. And if I'm saying it is very, very, very large, I mean it, because it does not directly say that it includes cryptos. It does not directly say that either it includes metaverse or Ethereum or Bitcoin or any other cryptocurrency or NFTs. But the language in which it is drafted, and my understanding says that this definition has been adopted from the crypto bill, which is to be tabled in the parliament. So this definition is adopted from there. The language of this definition is very vast. So if you see virtual digital asset, at the end of the day, there might be a situation wherein other than these cryptocurrencies, other than NFTs, other than metaverse, other kind of virtual assets may also be included in this. So for example, you swipe your credit cards and you earn certain points. And then you redeem these points for certain value vouchers, which you can enjoy at any other store. So these vouchers or these points can also form part of virtual digital asset. The language is so vast. So one is virtual digital asset. Now, if you have a virtual digital asset, what is the taxability? The taxability is provided under section 115 BBH. Section 115 BBH says that if you transfer any virtual digital asset, there would be a tax liability on the gains at the rate of 30%. So if you have a gain, if you have sold a virtual digital asset, whatever gain you have received would be taxable at the rate of 30%. Now, what would be the definition of gain? What would be the meaning of transfer? Whether section 115 BBH is a charging provision under the act or not. The language, if you read 115 BBH, the language of section 115 BBH is so loose and so not very well drafted that at the end of the day, it leaves you with many queries and questions. And instead of settling the position of taxation on cryptos or virtual digital assets or on NFTs, I feel they have somehow complicated the whole issue altogether. Section 115 BBH says that while computing the gains, you can only get the benefit of cost of acquisition. So for supposedly you sold your Bitcoin for, let's say, 28 lakh rupees today, but you purchased it for 14 lakh rupees. So you will get the benefit of 14. So the profit would be 14 lakhs and you will only get the benefit of 14 lakhs cost of acquisition. Now, what would be the situation wherein I have myself mined the crypto? It may not be possible that I have only purchased the crypto. I would have mined it. I would have employed a lot of people. I would have invested in supercomputers and I have mined. So what would be the scenario in that? What would be the cost of acquisition in those cases? Nothing is defined. Then they says that if there is any loss on sale of such or transfer of such virtual digital asset, then that loss would not be an allowable expense. And you cannot set off that loss. You cannot carry forward that loss. And you cannot set off and carry forward that loss with your any other income. So supposedly I have a loss of say 10 lakh rupees while trading in my virtual digital asset. I cannot set off this loss with any other income, whether it is a virtual digital asset or whether it is of my income from any other head. So the purpose of the government is very clear that we are going to tax this asset. We are not going to allow you any loss, not going to allow you any expense if you have incurred while purchasing or selling this asset. Supposedly, I have taken a loan and from the loan money, I have invested these funds into cryptos or virtual digital assets. What would happen to the interest cost? Whether I would be able to capitalize it or not? Nothing, no clarity is provided still under the Act. The section 115 BBH clearly says that the taxability would be at the rate of 30%. That's it. Now, if you see or if you do the fine reading of the Act, there is always a charging section. And section 14 of the Income Tax Act provides that your income is chargeable to tax under 5 heads, whether it's salary income, house property, business, capital gains, or your other sources income. Now, what is this virtual digital asset? It cannot be my salary income. It cannot be my house property income. Now, whether it is my capital asset, capital gain, or whether it is my business asset, or whether it is my other source income, this has not been provided. No amendment has been made under section 2, subsection 24 of the Income Tax Act, which defines the word income. So under which section the chargeability of this is coming? So either the government is saying that yes, it may be a capital asset under section 2, because capital asset includes any property and hence it's a property. But for purpose of computing the gains, you cannot follow the capital gains computation provided under section 45, 46, 47, 48. For that, you have to come to 115 BBH. Or they are saying that you can keep it as a stock in trade. It is a business asset. And hence, the taxability would arise under the head from income from business and profession. But the tax rate would be 30%. No expense would be allowed. No loss would be carried forward. there is no clarity. In my view, on fine reading and the fine print of the finance bill, I feel that there is a loophole. They have missed out providing for the chargeability of this virtual digital assets. Since they have defined virtual digital assets separately, they either should have included it in the definition of capital asset, or they should have clarified that it is chargeable under section 56. By defining virtual digital assets separately and providing for its taxability under section 115 BBH, they have certainly created a way wherein we as tax lawyers can go and argue that the law does not provide for chargeability of any gains, though it provides for percentage, a tax rate, but there is no chargeability coming. The charging section and the computation sections are different under the law. Yes, there is a computation provision under the law, which is 115 BBH. But from where does the chargeability is coming? Or either you tell me, yes, it is a capital asset because capital asset includes any property and hence it's a capital asset. But the computation would be as per 115 BBH. Then I have other points. If it is a capital asset, then section 47 comes into play. Any gift of any virtual digital asset, then it would be exempt. Any transfer of any virtual digital asset by a holding company to a subsidiary company or vice versa would be exempt under section 47. Then there may be many scenarios which would come in. I may not get the benefit of indexation, or I may not get the benefit of section 48 or regarding the computation of the capital gains, but I may get the benefit of section 49. I may get the benefit of section 47. So considering the whole way in which this law has been brought in, there would be a lot of litigation when it would come to the taxability of this provision of such kind of assets. Now let us come to 2018, when this whole debate on crypto was at the peak in India, and RBI came up with a circular in 2018. In 2018, in April, RBI came with a circular which said all the banks and all the financial institutions to which it regulates, that all the regulated entities which are dealing have to settle their accounts with all these unregulated entities of virtual currencies, and they should not deal with them in future. 3 months time was given to all the regulated entities to square off their accounts with all the other entities which are dealing, or exchanges which are dealing in virtual currencies. Matter went into the Supreme Court. Honorable Supreme Court struck this circular down. Now, since 2018, till now, there is a whole lot of debate upon the legality and illegality of virtual digital assets, cryptos. One side of the table is saying that by bringing taxability on cryptos, the government has indirectly legalized cryptos in India. This may not be the correct version, because as Prakash ji also have a view, and we discussed this yesterday, and he may also chip in. Income tax law does not say that we only tax a legalized income. This position of law is very much clear. Even if it is your illegal income, it is very much taxable under the income tax law. But I have a different view altogether. In my view, just because there is a whole lot of debate on legality and illegality of cryptos and digital assets in India, still there is no law which bars them. There are a lot of exchanges which are still operating in India. People have linked their bank accounts on these apps. People are trading in cryptos. People are buying and selling Bitcoins, Ethereum, Ripple, many other cryptos. And hence, there is no illegality as such in buying and trading in cryptos in India. There is no law as such. In my view, this is an unregulated sector. The government is still not sure how to regulate it. And not even in India, maybe outside India also, many governments are facing the same difficulty. They're not able to manage how to regulate the whole concept of blockchain. Hence, it may be an unregulated territory, but certainly it is not an illegal territory. So since it is unregulated, yes, you can trade in, you can purchase, you can sell. Hence, the taxability may not have an effect upon its being regulated or unregulated. Now, another interesting point which I have to add in here.
Suji, chip in for 1 minute here.
Yeah. Prakash, your voice is cracking.
Am I audible, sir?
Yes, please. Please go ahead, sir.
Okay. Thank you, Pransuji, for giving me the opportunity to chip in this really a very good debate which is going on the virtual digital asset here. My view is a bit different from what you have stated here.
Yeah.
My view is that under section 224, there is already a provision which says that income includes profit and gains. So if the income includes profit and gains, so whether it is required to be a separately mentioned item that the income from the VDA will be taxable under this provision, or it is like this one? Because my understanding is that if the income includes the profit and gains, which is there under section 2 subclause 24, then the gain arising from the transfer of VDA is already covered under the term income. If it is covered under the term income, then the issue arises whether it is covered under the income from the business or it is covered under the income from any other source. If a person is doing the business, if you can say that, yes, he is doing the business here, then yes, one issue can be there, he is a business income. And yes, for the purpose of taxation, there is a special rate has been given on that part here. And there is a special computation mechanism has also been given. The computation mechanism says that, okay, only to the extent of the cost of acquisitions that has been cost of acquisition, you will get the deduction and no any other cost. And similarly, they also bar you from the carry forward of such losses or the set off of the such losses. It is one of the point here. Second point, which is there, that legislative has intentionally not kept this VDA into the definition of the capital asset. They have made a separate provision 247A. I feel that is the section that you have inserted here. So it is not a capital asset. Yes, it is there. So it is out of the capital asset, and there should we should not consider the capital gain part here. This has been done. What I have learned, what I have listened in the earlier seminar, this has been done intensely to keep out of any indexation benefit, any long-term or short-term issues. There is no issue of any long-term capital gain or short-term capital gain, any indexation or like anything or any fair market value, what is there under section. So this is a deliberate attempt by the legislature to keep under a separate provisions of the 115 BBH. Now the issue what you have mentioned that chargeability part that I have tried to cover on the, yes, on the 15 BBH, I have already covered here. Another issue was you have raised about the term transfer here. I feel that yes, there's a debate on the term transfer because the term transfer has not been defined. The term transfer under 247 is qua the capital asset, not the any other property. Yes, that will be issue. Another issue will be there under the section 56 to 10, how to define the value, how to arrive the value of the, particularly the VDA, how to calculate the fair market value of the VDA. And most importantly, I was just listening to, I was just going through the newspaper where it was saying that if the cryptocurrency has been used for the purpose of the ESOPs, then it will also be counted for the purpose of the perpetuity.
Yeah.
So the issue will again arises how to calculate the fair market value of that type of ESOPs here.
So I'll come to that, Prakalji.
I didn't knock, your room was open and you were not called. I shut it.
Thank you for chipping in. To come to section 224 again on income, yes, it includes profit and gains, rightly said, but apart from profit and gains, there are other 17 subclauses. So if section 224 would have been so simple, then there would not have been other 17 subclauses in it. And you know, there are a lot of other issues which would come in, and you, as you rightly said, amendment has also been made under section 56 to 10. Section 56 to 10 says any property received by any person from anyone which is below the fair market value, or where the consideration is below a fair market value, then that taxation would arise under the head income from other sources. Now the amendment says that the word property would include virtual digital asset. The section 2 of capital assets, defining capital asset, says any property. Property is not defined under section 2. Then for that purpose, may I go to section 56, meaning of property, which may include virtual digital asset? So there can be a lot of scenarios wherein we can try to justify it to be a capital asset or a business asset, or maybe income from other sources. Now, interestingly, what would happen now when they have included this in property definition in section 56? Supposedly, you gifted me a virtual digital asset of cryptocurrency. It would be my income. Now, what would be the amount of income? What would be the fair market value? For that, they have to amend Rule 11U and 11UA of the rules.
As I have heard that they are coming with the separate valuation rule for this purpose here.
Yeah, obviously they would come. Anyways, they would come. But then it would be very interesting to know which exchange or which portal or which forum they would certify to be the true value. They cannot say that the cryptocurrency or Bitcoin would be valued at this rate. They have to refer it to some exchange. Whether it would be Binance, whether it would be WazirX, whether it would be CoinDCX. So that would be very interesting to watch for, whether they are indirectly would agree that, okay, the value which is coming on all these portals or on these apps or exchanges is valid. So it would be very, very interesting when they would come out with rules and this virtual digital asset law, which they are trying to table before the parliament. One more point before I finish, I want to add is the angle of FEMA in this, and the angle of withholding, which they have introduced under section 194S. Now, I have purchased my virtual digital asset from WazirX. Let's suppose there is an app which is available on app stores, which is a Binance app, and I can transfer my virtual digital asset, my cryptos, from any wallet to the Binance wallet. Where is the server of all these wallets? Where are the server of all these applications, whether it is in India, whether it is outside India? How these Bitcoins, cryptos came into India? Whether I'm making the payment to purchase these cryptos have a FEMA angle. Once I've transferred my crypto from the wallet in the Binance wallet, whose server is situated outside India, does it become my foreign asset? Do I have to report Schedule AL, foreign asset liability, in my income tax return? So these are a lot of complications and a lot of other issues which would come in, because in one of my clients' case, we have received a black money notice under section 10 of Black Money Act. He was holding cryptocurrencies and the department is alleging that this is a foreign asset. Since you kept all these cryptos in a Binance wallet, whose server is outside India.
Pransuji,
Now they have, Yeah, please. Sorry.
Yes, one minute, sir. If you go to the withholding part, I'm not going to the FEMA part right now. If you go to the withholding part, the statute says any person responsible for paying to a resident, so it is a payment here, any sum of money by way of consideration for the transfer of VDA shall at the time of credit of such sums to the account of the resident or at the time of payment of such sum by any other mode, whichever is earlier, deduct the amount equal to, like this one. The point is that the law does not require the situs of the VDA. Law does not require the situs of the server on which the VDA is there. It is simply saying who is the payer, and the payer, while he is paying to a person who is a payee and the payee is resident in India, then the tax has to be deducted. They simply said when a person paying to a resident in India. So the point is that
Yes, I totally agree. This is for withholding tax purposes. But if you go and read the black money, foreign undisclosed income and asset law, which defines what is undisclosed foreign asset, the definition is so huge that any crypto kept in a foreign wallet would tantamount to be an undisclosed foreign asset.
I will come to that part separately. My issue is only the withholding part right now. I'm just replying on the withholding part.
Yeah.
For the purpose of withholding, it is not to be seen in which server the VDA is there. It is not to be seen like where the server is located, the situs of the server. What is important that we have to identify who is the payer. The problem is that in the case of exchanges here, what I have understood that we don't know that who is the payer. Sometimes if it is a peer-to-peer, that we can identify that, okay, he is the payer. But in some time, it is the exchanges who pays this. So therefore, the problem is that with the legislature that they are not able to understand who is the payer and how to capture the payer. That is the most important part.
Yeah. So Prakashji, are we looking at a scenario that since these transactions are through exchange and the buyer does not know or the seller does not know the other party, we may come to a situation wherein this section 194S may be hit by a doctrine of impossibility.
Yes. That is the point which I am trying to raise, that because I was talking to some of the revenue department person in this case here, and they have rightly raised the issue that going into this fact, we are not able to identify where is the payer is sitting, where is the payer, and how the payment is made. Because in your account they will be credited through the bank account or through the exchange. Exchange does not know who has purchased this or who has paid this part here.
And if you fine read this section, one more point I would like to add, that this section is also applicable to non-residents. So it says any payment to a resident. So whether it is payment by a resident or a non-resident. So even if a non-resident is making a payment to a resident, he also has to deduct withholding tax.
Agree. That is agree.
So besides these points which Pranshu and Prakash has mentioned, of course there are other points like gift, whether this gifting of virtual digital assets should be taxable under
Shut up.
6 and
Shut up.
Yeah, and then apart from that any expenditure made by the companies for their expenses, day-to-day expenses in the businesses, whether any payment done through cryptocurrency is going to be allowable expense or not. There could be many more issues in terms of even from a business point of view, apart from the personal matters. So that has not been addressed in this. Yeah.
True, Nidhi.
Actually, one more point that I would like to add, ma'am. Very important point here. Just if you go to the background of this VDA in India, it started from the 2016 here. And in 2017, there was an interministerial committee that was formed the report here. And in this committee, they framed that all the private cryptocurrency will be illegal in India. What they have, this is the, and they mentioned that RBI will be issuing the virtual currency. Based on this direction, RBI has issued a policy paper in 2018 And based on this policy paper, the circular which was issued on the April 2018, which was passed by the Honorable Supreme Court on the ground of the proportionality, because the RBI was not able to demonstrate how the scheduled bank is being hit by this type of transactions here. That was the issue that was before the RBI, before the Supreme Court. However, after that, there was one bill was supposed to be tabled. There was one bill was supposed to be on the parliament, but however, that bill didn't see the light of the parliament. I have not seen that bill has been presented in the parliament. The bill is not in the public domain also. What I have heard from the media news, that the private cryptocurrency will be illegal in India. And it is the, and when I compare these words with the revenue secretary word, when the revenue secretary day before yesterday, or I feel 2 or 3 days back in the press news, when he stated that they are not discussing the legality of the cryptocurrency in India. The cryptocurrency,
very good.
So, so Prakash, you are right. Actually, cryptocurrency, they might not have.
Very good.
So they might not have said that, but they did mention about
Very good.
digital rupee. So we don't know whether any digital rupee is going to come, and that is going to be part of digital assets. So that has to be seen.
Very good.
I have a point here, so if you read what Finance Secretary said, he said that crypto would not be a legal tender.
Yeah.
So there is a difference.
Yeah.
It may be held as an asset, but it may not be a legal tender.
Yeah.
Yeah.
So
Yeah, it may not be a currency, but it may still be a legal asset to hold.
Yeah. So Pranshu, can you move to the other points? Because
yeah. So I'll request Prakash ji to take us through section 194R, and considering the time constraint, if any time left, then we'll take about the updated returns. Prakash ji, over to you.
Yeah,
Yes.
and I would request the participant, if you can start sending the questions on the chat box, it will be good to take up in between. Yeah, Prakash.
Thank you, Briggs, and thank you, Nidhi, and thank you, Pransi, our co-panelist here, for giving me the opportunity to deliberate on the very interesting issue of the 194R. 194R is not a standalone. For the purpose of why I'm saying that it is not a standalone, we have to understand the concept of section 37. What is happening in there, many companies are distributing their freebies, like particularly in the pharmaceutical industries. They are distributing their freebies, their benefit, their perquisites to their doctors or some this one's here or some persons here. In lieu of that, they are recommending these type of patented drugs and not the generic drugs. And for this purpose, they are getting some benefit like foreign tours, like some club membership, like some cash and other incentives, like some gift, etc. This matter came before the Himachal Pradesh High Court. And in the Himachal Pradesh High Court, it was mentioned that under section 37(1), these type of expenses, which are not a expenses, legitimate expenses, because why it is not a legitimate expenses? Because the accepting of the gift by the doctors was not as per the ethics of their profession. So therefore, it was stated that these payments are covered under section 37(1) explanation 1, and so therefore it will not be allowed as a deduction. It was the Himachal Pradesh High Court which was there into that part here. And based on this part, there was a circular also which was issued by the CBDT saying that these type of gifts were not allowable deduction under section 37. It has, after that, it has a long checkered litigation also. There was some high court who was allowing it, some tribunal who has allowed it, and it was the case came from the Bombay tribunal here. In the Bombay tribunal, in one of the important case, they allowed this type of deduction, saying that this type of deduction does not apply to the pharmaceutical company here. After that, in the Bombay Tribunal, there was a case of Macleod Pharmaceuticals. And in this Macleod Pharmaceuticals, Justice Honorable ITT member Pramod Kumar discussed the provision of Section 37 in detail. And he also discussed that these type of freebies, that these type of benefits are not in accordance with the law. And after this, the matter was referred to the larger bench. Taking the clue from that part here, when there is a different view that was coming from the tribunal here, the legislature has tried to clarify it. There are two things which are clarified here. One, they have clarified the explanation one of the 37, and 37 one explanation has been clarified through the another explanation that is called the explanation 4. If we go to that part here, we say that I'm just going to the 37 part here. And because that 194 is linked with the 37, somehow it is linked with the 37. So we can go into that part here. How the explanation, after the explanation 3 was inserted, and explanation 3 says that for the removal of doubt, it is hereby clarified that the expression expenditure incurred by an SSC for any purpose which is an offense. So if the expenditure which is an offense or which is prohibited by law under explanation 1 shall include and shall be deemed to have always include the expenditure incurred by the SSC. So by way of explanation 3, the legislature has tried to clarify what is the explanation 1. And for this purpose, in the explanation 3, there are 3 things which have been mentioned. It says that for the purpose, expenditure for any purpose which is an offense under or which is prohibited by any law for the time being in India, for time being in force in India or outside India. So if there is an offense which is whether in India or outside India, and for that any expenditure has been incurred, that expenditure will hit the explanation 1 of 37, and that will not be allowed. Another part which is quite interesting part is that in the clause number 2, it says that if any expenditure has been incurred to provide any benefit or perquisite by whatever form, very important part, any benefit or perquisites by whatever form to a person, whether or not carrying on the business or profession or with exercise of profession, and acceptance of such benefit or perquisite to such person is in violation of any law or rule or regulation or guidelines as the case may be for the time being in force governing such person. So this means if a pharmaceutical company is giving a gift to a doctor, and since the doctor is not ethically authorized to receive any gift from any pharmaceutical industry or pharmaceutical company for the purpose of recommending any medicines here, and since doctor is a person who is covered under who is carrying on his profession, it is not quite the imply if he's carrying on the profession, and this profession is guided by the ethics, and if this ethics says that if it is not as per the ethics, it says that if it is not, it is the violation of the law, rules and regulation and guidelines, then such expenditure will not be allowed for the purpose of deduction. Third part was that to compound the offense under any law for the time being in force in India or outside India. So all the 3 parts were for the purpose of clarifications, saying that if there any offense which has any, if there is any offense in India or outside India, that then deduction will not be allowed. For the compounding of any offense, the deduction will not be allowed. Like we know that under the Income Tax Act, lot of provisions are there where the compounding is there. If we have incurred certain expenditure like compounding charges, then this expenditure will not be allowed for the purpose of deduction. That will hit by 37(1) explanation. Now coming to the perquisite and benefit, it says that if the perquisite benefit which is not in accordance with the law or the ethics of the person who is receiving it and who is doing the profession of such of that part here, then this deduction will not be allowed. it is one of the important issue that first of all the deduction is getting not allowed. However, it says that the another provision it say is that if, however, an company is making a payment for the perquisite or benefit, then they have to ensure then the tax has been deducted. So there are two parties there. One part they say that it will disallow only those part which is not as per the ethics of the person who is receiving it. But if it is in accordance with the person receiving it or not in accordance with the person who is receiving it, then what will happen? It says that there is an important provision. It says that where 194 is there, and this is onerous. It is totally onerous because it says that any person responsible for paying a resident any benefit or perquisite, whether convertible into money or not, like this one, if you're giving to some gift or like this one's or some foreign tour or not, arising from the business or exercise of the profession by such resident, shall before providing such benefit or perquisite as the case may be to such resident ensure that the tax has been deducted. So before the payment itself, there is an onerous liability, the tax has been deducted. And such benefit and tax rate is 10% of the value of the aggregate value of the benefit of the perquisite. So the TDS is there, and TDS has to be deducted at the rate of 10%. And it says that before paying such or before releasing some benefit or perquisite, the issue arises how to value this type of benefit or perquisites here. We don't have any valuation rule for the purpose of benefit and perquisites. How to value this part here? Because, and most important issue is that when a company like gives some benefits or perquisites to a person, they may be in some packages, they may be in some lump sum part, or there may be some bulk of the person that who is availing this part. How to identify this person has received this much of benefit? So this needs a proper valuation rule for the purpose of implementation of the section 194R. Another onerous responsibility which has been casted upon the SSC is a payer. It says that provided in the case where the benefit of perquisite as the case may be is wholly in kind, if the benefit is in the kind or partly in kind or partly in cash, and the cash is not sufficient to meet the TDS liability, then what you should do? You should ensure that the tax has been deposited before releasing the benefit of perquisite. Then the payer has to ensure that the tax has been not only deducted, but that it has been paid before releasing the benefit of perquisite. And after that, there are certain exceptions. If the benefit is not more than 20,000 rupees, then there are certain exceptions. And if the payer turnover does not exceed 1 crore rupees, or if he is in the business, or the payer business or payer turnover gross receipt does not exceed 50 lakh rupees, if it is in the profession, then this provision of 194 will not be applied. Now coming into this part here, there are two limbs. One is the 37, one is the 194R. 37 says that if this payment is unethical, if payment is contrary to the law of the person who is receiving such type of gift, then it will outrightly be not allowed. Come to the section 194R. 194R does not say whether it is whether it is in accordance with the law or in violation of the law. Any payment which has been done, you have to comply the 194R. So the point which I am trying to say, even there may be some circumstances where the expenses has been disallowed under 37, still you have to comply the requirement of the 194R. 194R sacrosanct. 194R is not dependent upon the section 37. Another important issue that is coming up with a lot of clients are asking me, Prakashji, what is the valuation rule when we have to calculate if I am giving a bulk package to a group of the person who is availing this part, how to say that this person has received this much, this person has received this much, how to implement this part here. I am requesting all my client to hold on till the time I get some clarification from the CBDT or some final printout of the law. Thank you, ma'am. This part is over from my side. 37 and 194R.
Thank you, Prakash ji. One important point which is to be noted in 194R and 194S, both the sections, is that you have to deposit the tax before transferring any benefit or before transferring the consideration. Generally, in the TDS provisions, you can deposit TDS up till 7th of the next month. But here the section clearly says that you have to pay the TDS before transferring the consideration or the benefit to the other side. So this is something which is to be noted, because this may lead to interest implications.
Yes, it is totally onerous here.
Yeah. Here I would like, if Archana is on board, if Archana can join and share her views on the GST side of such kind of payments given to dealers or other associates of the business, such as gifts, etc. Or Nidhi may join in.
Archana, you are not audible.
Am I audible now?
Now it's good. Yeah.
When we have the privilege of Archana here, so we can also discuss whether the VDA is a goods or services under the GST.
It is neither a good nor a service.
Exactly. So I'm hoping that the government may bring it to in sync with money, and they may brought this into the Schedule 3, so that neither it is a supply of goods nor a services, and maybe we are expecting much more from the government.
Hello.
We have to see. But anyways, if I talk about that one aspect that 37 is also talking about, and the gifts and the perquisite that we talk about, and which is a very common scenario in pharma industry basically. So my opinion is, if something is eligible as a expense earlier also, then there should not be any denial. But yes, now there is a blanket coverage, so I don't know. But otherwise also under section 17 subsection 5H, there is a restriction. Anything that has been given as gift or samples or without any consideration has been disposed of, then again the restriction is there. So yes, it is all going to be a mixture of all those provisions.
Great. Thank you so much, Archana. So with this, considering the time constraint, we have already taken an hour and we are left with only 50-55 minutes for the indirect tax team. So without wasting any time, I would hand it over to Archana for taking over to the indirect tax amendments. If there are any questions, we can take it after the indirect tax team session. So we can have a combined Q&A round. Over to you, Archana. Thank you so much.
Thank you.
Before you begin, Archana ji, I'll ask Suzanne to briefly introduce the panel. Suzanne, can you do the needful, please? Yeah.
Thank you so much. First of all, a huge thanks to all our speakers for such a power-packed panel and extremely insightful session. Moving on, I would now like to invite and introduce our speakers and moderator for the second panel, that is discussion on indirect tax proposals. We have with us Ms. Archana Jain. She is a homemaker turned professional. She's very passionate about learning new skills in life and pursuing dreams. And she started her career as a second inning of life, but still managed to run a marathon and has had a great experience of over 10 years in the field of indirect taxes, compliances, refund, audit, advisory, and litigation. We have with us Mr. Sarthak Garg, who is a chartered accountant by profession and a member of the Institute of Chartered Accountants of India. He's also a member of the Indirect Tax Committee, BRICS CCI. He's currently leading the indirect tax practice at Garg Manoj & Associates, Chartered Accountants, New Delhi. And last, we have with us Mr. Saurabh Baser. He is an experienced chartered accountant with a demonstrated history of working in the taxation and accounting consulting firms, skilled in tax preparations, direct and indirect tax, litigation services. Internal audit, financial accounting, and project finance. Handing it back to Archana ma'am.
Thank you so much. Thank you, Brex. Thank you, Nidhi. Thank you, Avinav Consulting. Thank you, our sponsor, JK. And thank you to all the eminent speakers with whom I'm sharing the platform today and to all the August participants. And yes, after that powerful direct text session, I think now it's the onus is on us to be as good as they were and as impactful as they were. And they were also talking about some virtual assets. And even in our indirect tax regime, I think the most favorite virtual asset is ITC ledger or input tax credit, which has been the favorite topic for all these 4 years. And we have seen n number of amendments in this one particular aspect. It started with 4 conditions under section 16 of CGST Act. Now they have introduced one more condition. So now in totality, there are 6 conditions before I can actually claim that input tax credit as my eligible tax credit. And also the eligibility is not just for the compliance that I have to do from my side, that is from the side of a recipient, but also the onus is on me only for all the compliances that has to be dealt by the supplier also. So again, I mean, I don't know what kind of hardship they have planned for a bona fide taxpayer. What I feel is that 16th section has been amended with only one thought in mind, that is how to get hold of the culprits, and those culprits who are not in their reach, they are not in their hold. So whatever or whosoever is coming on their way, they are only making their life more stringent, more conditions are being attached. So the opening remark of a GST was a seamless flow of credit. But after the 4 years and the amendments and this latest insertion of another clause in subsections 2 of section 16, it seems like seemingly less credit. I hope you all will agree to me. So now what they have done is they have added one more condition. There has been a
Wait 1 minute. Wait.
complete revamp of the provisions. There has been major shuffling under this budget. The flow that was ever expected from GST, like 1, 2, and 3, has been completely done away with. So now the condition of section 16, that is the eligibility of my input tax credit, has been added one more feather in that provision, and it says my credit has to be dependent upon the compliance aspect that has been taken care by the supplier, meaning thereby in case the supplier has exceeded his share of credit and he has done something which was not eligible for him to do, and he has passed on or he has filed the return, so then again my credit will be denied because that amount which he has set it off while filing his GSTR1 was not his
Wait.
eligible
Wait.
credit.
Wait.
So I just want to have
Wait.
I just want to say one thing, that
Wait. Wait. Wait.
Ma'am, Archana ma'am, you're on mute. One second.
Also, Archana, could you speak a bit loudly, so the voice is coming very low.
okay, now it is fine.
Yeah, better.
Okay, so what I was saying is that whatever the supplier has utilized, that has to be legitimate, that has to be eligible, that has to be within the threshold limit that is allowed to him. Then only my credit will become eligible to me. So these are the things that they have added. So that means whatever the mistake a supplier is doing today, I can be held responsible. So
Ya твоя мама в рот
one
ебать.
question, that what if, or what about
Я
all
твоя
the
мама в рот ебать.
I don't know, some malware function is there.
yeah,
Can you
I
guys?
think there is some malware function because some
Pardon me.
other language name is appearing.
Sorry.
Some person
It is
here.
by the name of Mackim, something of that sort.
1 2 3 4
Now it is 4.0.
Just a sec. Let me just, because I can't see anybody talking here and the sound is coming. So then can you just fix it once?
I removed the number. I think the person just changed the name to a number and I removed that. Yeah.
Okay. Just keep a tab.
Yes, ma'am. I'm just checking that.
Thank you. So my query to all the speakers as well as to the participant over here is, what about all the litigation that is going on where the supplier is at some mistake, or where the supplier is absconding, or the supplier is not available as of now, and the recipient is caught hold and he is held responsible, and he has been demanded with the reversal of the input tax credit along with the interest, because this new insertion is a prospective amendment, and with this new insertion only it is sufficing that yes, from now onwards this provision is there in the law that the supplier, for any mistake of the supplier, the recipient can be held responsible. But what about the litigation that has already taken place, or what about the litigation that are already in process? It is again a big question mark. And with this, I'm just handing over the podium to Sarthak to give his input on this new addition of Section 16, new entry of new restriction by way of new insertion.
Good evening, everyone. Am I audible? Okay, great. So thank you, Archana ji, for explaining the proposed amendment and giving useful insights on the changes under GST in the budget. And thank you, Suzanne, for the kind introduction earlier. So before providing my views on the proposed amendments under GST, I would like to highlight that a reading of the fine print of the finance bill clearly indicates the government's intention of tighter and stricter GST laws, which shall be proposed in the ensuing times. So these amendments are likely to have an adverse effect on the working capital of the taxpayers. So the amendments proposed under the GST Act majorly relates to strengthening the mechanism of availment of input tax credit, with several new restrictions proposed to be applied. So the main purpose of the amendments under the input tax credit provision has been to curb the menace of fake invoicing under GST. Though some of the amendments are in favor of the taxpayers, however, it cannot be denied that major amendments are revenue friendly. So as just Archana ji discussed, one of the major most important amendments which have been proposed under GST has been under Section 16, read with Section 38 of the CGST Act. So an additional condition which is to be satisfied for availment of input tax credit has been inserted vide clause BA under Section 16, subsection 2 of the CGST Act. So by virtue of this amendment in GST Act 2B, if the input tax credit appears in restricted category, the same cannot be availed by the registered person. So the conditions where the input tax credit can be restricted under GST 2B has been provided under the new revamped Section 38 of the CGST Act. So there are 6 conditions which have been provided under Section 38, subsection 2 of the CGST Act. So these 6 conditions have been directly linked to the default of the corresponding suppliers in order to deny the input tax credit to a particular recipient. So as per my view, the proposed amendment seems to be very harsh and draconian, as it proposes to deny the input tax credit to a recipient in case his corresponding supplier has defaulted in payment of tax to the government, or has even availed the input tax credit in any contravention to the input tax credit reflected in GST 2B. So it appears that by way of this proposed amendment, denial of input tax credit to the recipient has been directly linked with the supplier's fault, which is practically out of recipient's control. This amendment is likely to cast an additional responsibility on a bona fide recipient so that he can have regular checks on supplier's compliances for input tax credit availment. So this condition appears to be very contradictory and would essentially shift the incidence of tax from supplier to the buyer, which shall be challenged constitutionally before the higher courts, I would say. So currently there is no robust mechanism provided under the GST law or under the on the GST portal to check and verify suppliers' tax compliances. I believe that there would be many practical challenges in implementation of this provision. A taxpayer does not have any access to the returns filed by the suppliers, and therefore the denial of credit on the ground that the supplier has not discharged the tax so collected is unfair and definitely beats the idea of seamless flow of credit. It has been held by courts from time to time that a taxpayer can only be responsible for his books of accounts and tax compliances, and he cannot be held liable for answering what is there in the books of accounts of the corresponding supplier, I would say. A taxpayer can take steps which are in their control, beyond which the buyer cannot be expected to verify the records of the supplier in order to check whether the supplier has done any default or not. So as per my view, a recipient can only be held responsible for his tax compliances and not the tax compliances of the corresponding supplier. So introduction of this amendment fortifies the very basic purpose of GST, that is the seamless flow of credit through the entire supply chain. This proposed amendment would impose an unreasonable restriction on the bona fide buyers in availing the input tax credit of GST. So in the past, it has been categorically held by various courts that default of supplier cannot be a ground to deny the legitimate input tax credit to a bona fide recipient. So reference can be made to the judgment of Arise India, Quest Merchandising, Ongsi Designs, where it has been specifically held by the courts that input tax credit cannot be denied to a bona fide buyer on account of any default on the part of the corresponding supplier. Further, the Honorable High Court in the case of Sri Ranganathan Walls Private Limited held that input tax credit claimed by an assessee cannot be denied solely because the dealers from assessee which has purchased have not paid taxes. So basically, in nutshell, I would say that the buyer cannot be held liable for any default in payment of taxes, in furnishing of returns that has been done by the corresponding suppliers. So here I would like to highlight that there is a very important legal principle that law cannot compel a man to do that which cannot possibly be performed. So this principle has been reiterated in a number of judgments wherein the honorable courts have accepted its admissibility and have also elucidated in its definition through reference in various illustrious authorities. So courts from time to time have held that input tax credit is a vested right and the same cannot be denied on the circumstances that are beyond the control of the recipient. In the GST regime as well, the courts have held that input tax credit cannot be denied to a recipient without attempting to recover firstly from the supplier, the corresponding supplier. So reference can be made to the judgment of the Honorable Madras High Court in DY Beather Enterprises, where the court has specifically directed that recovery should be firstly made from the suppliers, and thereafter the corresponding purchasers should be pursued. So in my humble view, the legal validity of this proposed amendment of Section 16, read with Section 38, shall be definitely challenged and tested judicially, as the same shall have a negative impact on a bona fide purchaser. So a lot of litigation is likely to arise on account of this proposed amendment. However, since this provision has been introduced, it is advisable for buyers to safeguard their rights contractually in circumstances where the suppliers fails to deposit a due tax charge on a particular transaction. So now I would like to ask Mr. Saurabh to give his expert views on this proposed amendment. Over to you, Saurabh.
Yeah, thank you, Sarthak. While both Archana and you have explained the provisions related to credit availment conditions, I have few data points which I would like to share with the audience. So since the rollout of GST in 2017, the credit provisions under Section 16 have been amended 4 times, in addition to more than 15 amendments in the underlying rules. Similarly, more than 10 amendments were made in the Section 39, which is related to furnishing of returns, and more than 20 major amendments were made in the underlying rules related to furnishing of returns. So this whole input credit was supposed to be the lifeline of GST law, and this continuous tinkering with the provisions and placing new caveats in every 6 months for availing credit has turned out to be a sheer harassment for taxpayers. And that too, these changes also comes with the cost for the taxpayers. So there is a huge cost to be incurred in revamping those IT systems for big corporates and even for MSMEs and small time business units. This continuous change in input tax credit and return filing process has increased the compliance as well as litigation cost. Coming back to further, they have also proposed an amendment in section 41. So wherein input tax credit needs to be reversed and interest is also payable if the supplier has not paid the tax to the government. Interestingly, this proposed amendment is also conflicting with the amendment in section 16 read with section 38, where they are denying the credit in cases where the supplier has not paid tax. And in the same case, you are also asking to reverse the credit under section 41. So if I'm not eligible to avail credit, where is the need of reversal as per section 41? So the only good thing is that they have proposed to allow re-availment of such credit. That too, I understand, without any time limit for such re-availment of credit if the supplier has paid the tax. Also, in addition to re-availment of input tax credit, whether the interest portion will be refunded or not, that is again a big question, because when the authorities would have recovered the tax from the suppliers, naturally they would have collected interest on that part also. So this will be in fact a case of dual levy of interest on the same tax amount, both in the hands of supplier as well as the recipient. So that's something related to input tax credit. Next is extension of timelines in relation to certain amendments and disclosures in GST returns. So if you see the current provisions, you can disclose and avail the credit up to the due date of filing return for the month of September of next financial year. So that date is falling somewhere in the month of October, around 20th of October. So in the proposed amendment, they have given the last date for amendment as November 30th. While it looks like an extension of 2 months, but if we go by the fine prints, that is not the case. So Sarthak, if you want to share your views on this.
So basically, I would like to mention that earlier the due date for availment of input tax credit for any financial year was provided as the due date of furnishing of the return under section 39 for the month of September, that is 20th October in case of monthly return filers, and 22nd or 24th October in case of quarterly return filers. So as per the amendment, the due date for availing input tax credit for a financial year is now proposed to be extended up to 30th November of the next financial year. So as per my view, this proposed amendment appears to have been on account of the closure of books of accounts and due date of filing of income tax returns, which are usually completed by 30th of November of the following financial year. So by this amendment, I believe that the input tax credit of GST for a particular financial year can only be availed if it appears in GSTR 2B up to the month of October and not afterwards. So effectively, by this proposed amendment, a window of additional 40 days has been provided to the taxpayers to avail the input tax credit of the past financial year. You know, earlier when the budget came, we all were thinking that additionally we have a period of 2 months, extra 2 months actually. But now when, we three were discussing earlier today, effectively we have been provided a window of 40 days only, additionally. So for example, it's an absolute date, and input tax credit for the previous financial year can be availed in any return which is filed up to 30th November. So basically for financial year 21-22, I believe if the GSTR 3B is filed by 30th November for any month before November, then input tax credit shall be available. However, if any input tax credit which pertains to the previous financial year is availed in any 3B which is filed after 30th November, then the same may be subject to litigation, I believe. So Archana ji, any views on this provision?
No, absolutely correct. And I hope now my voice is audible.
It's a bit low actually.
Okay, still it is a bit low. Okay. So yes, Sarthak, you have very well explained, and yes, the provision is also like that only, that 30th November is like a stringent mark with term and condition. Apparently, we have only an additional 40 days, but yes, one good thing is now the due date word is not there. So even if I'm filing the return on the, let's say on the last day of the expiry period, still my credit will be there. So that is a good point. And with this, now let's talk ITC we have talked about. Now let's talk something which is very dearer to us, that is refund. So yes, they have welcomed I'll welcome the change that has been introduced in refund. A few days back only, I had a session with Natarajan sir, and there also we have highlighted this issue that the relevant date is missing in case of a zero-rated supply, that is with respect to SEZ supplies. So now they have taken care of this anomaly, and they have inserted another subclause BA in the explanation 2. Explanation with respect to relevant date, clause 2, they have introduced a new provision which says that for the SEZ supplies, now the relevant date has to be from the date of filing of the return. So earlier there was a confusion because many people were taking the date of export of goods for the export. They were taking the same for the SEZ supplies also when it comes for the goods related supplies. And when it was a supplies of services to SEZ, then they used to take the provision applicable for the export of services because there was no separate thing. And most of the people were of the understanding that as IGST section 16 is covering the whole transaction of export as well as zero rated supplies, so they have equated the relevant date from that provision itself. And even I have seen some officers taking the date of endorsement as a relevant date for calculating the 2 years time period. So there were anomalies, but yes, now this anomaly has been taken care of. But still, this thing, as we all know, as it's a new insertion, and today also Saurabh was talking about this, whenever there is a new insertion, it has to be taken as prospective only. So I'm of the opinion, and I hope you all will agree to me that this is a prospective, but as it is a clarificatory also, so still we have to wait that how this proposal has to be seen. But yes, now we have a relevant date for SEZ supplies, that is zero rated supplies to SEZ also. Along with this, there has been an amendment in refund provision only. Section 54, subsection 10 has been amended. Earlier, it was linked with section 54, subsection 3. That was only where the refund of accumulated ITC in respect of export or in respect of inverted duty structure was there. They had the right to withhold. Now, the same has been changed from that provision to 54.1. That means any payment of refund which is of tax amount, penalty amount, interest amount, or whatever amount that has been paid and which has been granted as refund to the SSC can be withheld in case there is some kind of obligation that has to be left out or that has to be paid by the assessee. So that means in case any outstanding is there from the assessee side, then any refund can be withheld. So these are two things that has been introduced in section 54. So I'll ask my associate Saurabh or Sarthak to add something on this.
Right, Archanaji, I agree to your viewpoint that as far as the SEZ refund is concerned, there was no specific relevant date, I would say. So, the assessees had a view that the relevant date would be computed as per the residuary clause H, from the date of payment of tax. But the department has a contrary view that it shall be computed from the date of export out of India. So, this amendment was definitely required, but I certainly believe that for the past period, a clarification should be issued, by the government that what about the refunds before the amendment. उस time पे कैसे relevant date compute होगी? So, this would aid in avoiding litigation, I believe. Yes.
Yes.
Saurabh, any views?
Many
Yes.
cases which has been rejected, now they'll get a lifeline.
Right.
Yeah, Sarthak. So I think we can move to the next provision. Again, next is section 49, where they have inserted a new provision, subclause 12, wherein the government can prescribe a maximum portion of output tax liability, which can be discharged by utilizing input tax credit. So this provision was already there under Rule 86B, wherein they mandatorily required 1% of the liability to be paid in cash for notified class of taxpayers. So with this proposed insertion in the Act, they are somehow trying to fortify the position related to Rule 86B, just to counter in case there is any unfavorable judicial pronouncement. So this is in fact leading to a huge cash flow issue for certain large taxpayers who are compliant but not falling within that exception parameters. If at all the government is trying to curb the practice of fraudulent ITC availment, as Archana ji mentioned, they can have strong IT systems to detect the input tax credit frauds rather than putting a blanket restriction for taxpayers. So that's all from my side. Sarthak, if you want to cover other provisions.
So additionally, there has been another amendment in subsection 10 of section 49, So basically subsection 10 has been amended to allow the transfer of amount of tax, interest, penalty or any other amount available in the electronic cash ledger under the CGST Act of a registered person to the electronic cash ledger of a distinct person. So basically, if a company has multiple branches across, across various states, and they have balances in their electronic cash ledger, then the same can be transferred from one GSTN to another now. So this amendment has been proposed under section 49, subsection 10. So, but there is a condition that if the I remember there is a condition that registered person, if there is any unpaid liability in the electronic liability register of the person, then such transfer won't be allowed. So, while transferring any amount, the taxpayers must, take cognizance of this condition, I believe. Right. So, and Archana ji, any views on this, these amendments?
Yes, this is a welcoming thing that they are trying to do. And I think there was a provision that refund should be allowed by GSTR 9 form. But because of the technical issues and all these things were never put in line. So I think this is a new way of giving benefit to the assessee, where they are trying to simplify, because cash ledger is something which belongs to me only. So the right
Correct.
to get the refund should be available to me, and I should not be at the mercy of the portal or at the mercy of somebody else. And there is no requirement of document also, so that has to be also clarified, because still department is asking for various document whenever we go for a refund of cash ledger also. And
Correct.
yeah, so with this also I just wanted to add on a new amendment that has been proposed. It is not a new amendment, they have already clarified in the last GST council meeting also. That is with respect to the grant of license for the alcoholic liquor license, that it will be a part of schedule 3 now. That means it is neither a supply of services nor a supply of goods. So I just wanted to add on one thing over here. There is a lot of litigation going on with respect to fees and license. When they are having this thing in their mind and they are granting some kind of relief to the taxpayer, they should also issue a clarificatory note. There are certain statutory compliances that has to be met under the prescribed law that are applicable as on date. So whenever I'm putting across some fees, like some fees for my pollution certificate or some fees for other statutory requirement, then there is no quid pro quo. I'm not getting anything for that. So that cannot be equated to consideration. And we have seen there are not many issues pending before the authorities to decide whether the consideration that has been discharged for these kind of regulatory norms is forming a part of a fees or it is a license, because with license I get some right to exploit some kind of natural resources or some kind of additional right by virtue of which I will be able to extend my business, or I may transfer that right, or I may sell that right. But whenever it comes to some kind of compliance fees, that is a mandate requirement, and that is not a thing that should be equated with supply. So there should not be any levy of GST, and it should be covered under the entry number 47 of the exemption notification. But there is an ambiguity between the exemption notification and the RCM notification, by virtue of which these kind of litigation are still going on. So when they have amended notification number 25/2019 retrospectively, they should also come forward with some kind of clarification with respect to the fees or the licenses that are under the statutory compliance with respect to the law applicable as on date. So that was one thing which I just wanted to highlight when I just talked about this license fee. So anything you want to add on, Saurabh?
Yeah, Archana ji, and everyone, I would like to highlight one important amendment which I felt I should show. So another important amendment has been proposed in the finance bill is with regard to section 50, levy of interest. So, section 50 of the CGST Act deals with levy of interest. So currently before the amendment, section 50 subsection 3 provides for interest in case of excess claim of input tax credit or reduction of output tax liability which arises on account of mismatch as provided under section 42 and 43 of the Act. So, since the two-way communication process was never made effective since the inception of GST, interest under Section 50 is now being amended to be substituted retrospectively with effect from July 1st, 2017. So, now going forward, when the finance bill is, enacted, interest would be applicable only upon input tax credit wrongly availed and utilized due to any reason, and not only due to the matching concept, right? So the registered person will only be penalized with interest if he has wrongly availed and has also wrongly utilized the input tax credit. So consequently, the relevant notification, I think 13 of 2017, has also been amended retrospectively, so as to notify the rate of interest as 18%. So, this proposed amendment is a welcome move and a big relief for taxpayers. And it will definitely put to rest those disputes wherein the department has demanded interest for mere availment of input tax credit without its utilization. So the issue which remains unanswered is that what will happen to taxpayers who have already deposited interest at 24% on wrongful availment and utilization of input tax credit. So will they be eligible to seek any refund of the balance interest award? So I believe a clarification should also be issued by the government on this issue.
They will receive a big thank you, like any other taxpayers. And in this, I just wanted to add one thing. There has been lot many notices where interest has been demanded on the wrong availment of transitional credit with respect to cess, because there was an ambiguity with respect to the cess. The eligible duties has been amended as mentioned under section 140, 141 and 143. The anomaly was there. So what my perception is, or what my understanding is, that interest under section 50 cannot be charged on the transitional credit wrong availment. Why I'm saying so? Because the definition of input tax,
right,
as defined under law, does not talk about the transitional credit. So when something is not covered under the statute itself, you cannot levy the interest. And secondly, interest is only a compensation. It is in the nature of compensation to the revenue when there is something wrong has been done. When I'm transferring something which was already in my credit ledger, I'm not eligible to utilize the same, I'm reversing the same. So then where is the question arises for any kind of loss to the revenue? So in that aspect, my stand is that there is no liability to pay any kind of interest because there is no loss. The amount was earlier also in the credit ledger, today also it was in credit ledger, and I have reversed it because now it is not eligible. So there was no loss to the revenue, so there cannot be any interest on the same.
I completely agree, Archana ji. This is a very valid point, I believe. And adding to it, I must say that department does not have the power to verify the transitional credit itself, because the input tax credit definition does not include the transitional credit. So the demand under section 73 or 74 cannot be made because it talks about the input tax credit wrongly availed, right? And when the definition of input tax credit does not include the transitional credit, then how can you demand the wrongful availment of transitional credit from an assessee? So these are some issues which will see the light of the day in the ensuing times.
Yes. And as the issues reaches the highest forum, then until that we have to keep on fighting for the justice. I think this is the only thing. Then there has been an amendment, or I should say, I don't know whether it is a welcoming amendment or no, when that complete matching principle has been done away with. So now there is no hope for any kind of matching, online matching. So there is no hope for any GSTR 1, 2, and 3. So whatever they were supposed to do so that they are able to aid the recipient has been done away. So now they are expecting some kind of magic wand with the recipient so that he can check all the matching principles has been taken care of or not, whether the compliance by the other party has been done or not. So he's at least now he's left in the hands on the mercy of the portal itself. So now the 42, 43 and 43A, which like 43A, which was like again a big dream given to the recipients, which was never implemented, has not even saw the day of implementation, has been done away with. So they have been omitted from the act. So as you correctly mentioned, Sarthak, when they have been already amended or omitted, so now there is no question of 24% interest because that was linked with the auto matching concept of 4210 and 4310. So that is the reason now they have amended everything and they have reduced the tax rate to 18%. And yes, the plight remains for all those who have already paid 24%. So now there is no hope. There is no ray of hope for them.
Right.
Yes, Saurav, your take.
So I think this goes on to show that how rough this journey has been since last 4 years, not just for the taxpayers, but even for us as consultants. So this can be a classic case study down the line, 10 years or 15 years. This whole implementation process. So I hope that this whole return filing process and credit related conditions finally settle down, maybe in next 6 months or 8 months.
I just add one point with respect to section 16 subsection 4 where the timeline has been revised. So my take is that as the wording of section 16 subsection 4 does not give any criteria or any eligibility to my ITC, it only talks about where credit has been taken or take. The word take has been used instead of availed or utilized or claimed. So that cannot be equated with 16.2 because 16.2 is a non-obstante clause and it is overriding not just the section but complete section, not just one provision of that section but complete section has been overruled by 16.2. So my assumption is that 16.4 does not have any basis on whether credit is eligible to me or no. That means with respect to the timeline I'm only talking about. And also after the Supreme Court decision in the case of Bharti Airtel, where they have completely accepted the fact that whatever your books of accounts are saying, they are the primary source of the information for your legitimate books of accounts. So whatever you have taken in your books of account has to be awarded to you. There cannot be a denial. And return filing is only a procedure. Even in service tax regime also we have seen there have been plethora of judgment which talks about that filing of a return is just a procedure. It is a mechanism, but it is not the end of the day that everything has to be decided by the porter or by the return itself. So my view is that though they have extended the date, it is a welcoming step just for taking care of all the anomalies or any kind of omissions or errors that may have happened during the course of filing of the return. But as far as the eligibility is concerned, 16.4 is not a criteria. Again, I have to go back to 16.2 itself and my books of accounts, and now that has been even stamped by Supreme Court also in the matter of Bharti Airtel.
So I think they have already de-linked this whole 16.4 provision with this amendment in the extension of this date by 30th November. Previously, it was linked to the return of September. Now they have completely de-linked it. So I think that should be very clear from that perspective now.
Yes, then when my books are being finalized, I'm taking care of all the amendments and that can be taken care while finalizing the books itself. I think these were the few important changes apart from few small changes like some forms or like for e-commerce operator, they have made some amendment for the changes and all. I think we can hand over the podium to Nidhi for any updates on custom related things if she has. Or
Yeah, customs, right?
yes.
Yeah, thank you very much, Archana, Sarthak, and Saurabh, for this too much clarity which we have now in the GST. And of course, as you correctly said, Saurabh has mentioned about that 4 years have gone. It has been difficult for assessee and also difficult for the consultants because every day we need to get updated, and then even the discussion is required among peer consultants, because otherwise the clarity is not coming up. Even by a simple judgment or advanced rulings, we are not getting any clarity. And somewhere it's on that contrary views are coming and not even speaking orders. So that's too much of difficulty which we are facing. And a tribunal not being there in the central level, then it is also becoming too difficult. And okay, as far as customs is concerned, there is comprehensive review of customs duty exemptions have been undertaken through a process involving crowdsourcing and inputs from various ministries. In this context, about 350 exemptions have been withdrawn. After a detailed review of custom duty exemptions on capital goods and project imports, more than 40 exemptions relating thereto are proposed to be gradually phased out. Certain exemptions are being introduced for duty-free import of specified goods, by bona fide exporter of items like handicrafts, apparel, and leather goods, the value-added export goods shall be exported in 6 months, and exporter shall follow IGCR rules. IGCR rules is import of goods at concessional rate of duty rules 2017. Then there is, of course, there has been a lot of changes which has been provided. Actually, they have already done those changes in terms of issuing the notifications like project imports. So especially in the project imports, they have reduced the basic custom duty benefit. Earlier it was either nil, 2.5% or 5%. By way of various notification over many years, they have changed it to now 7.5. So any imports, project import registered till 30th of September 2022, those rates will be applicable. If any projects, when they get registered after 30th September 2022 with the relevant ministry, in that case, they'll have to apply 7.5%. So from 10%, it has come down. It has been 10%. It was there earlier 2.5 or nil or 5%. Now it will be 7.5%. So those project imports benefit has been given to various infrastructure, power, you take it, or roads, and even in many other areas in the infrastructure specifically, to give the benefit to boost those sectors in terms of import of goods. But since our government is been giving thrust on the manufacturing in India, they want to reduce imports. That's why they want to discourage project imports at a lower basic custom duty. And that's how they are slowly they are phasing it out and then bringing up to 7.5%. And then apart from that, there has been many other changes which has been proposed in this, like I did mention about custom duty rate, which whether the exemptions have been withdrawn or the rates have been reduced, and there have been rates which have been increased also. So there are certain significant changes are made in the customs. The definition of proper officer is being modified. Officers of DRI, audit, and preventing formations are being specifically included in the class of officers of customs. Explicit provision is being made for assigning functions to the officers of customs by the board of a principal commissioner or commissioner of customs. In a major trade facilitation measure, the import of goods concessional rate of duty, which I mentioned, IGCR rules 2017, have been comprehensively revised. End-to-end automation is being introduced in the entire process. Various forms are being standardized. Any transaction-based permissions or intimations are being done away with. Periodical statements under these rules shall also be submitted on the common portal. It seems that with customs, they are not only, of course, reducing the dependence of our industry onto import of all the foreign companies, but they are at the same time bringing up the manufacturing in India, and also with Make in India order, which has been, of course, modified over a period of last 2 years. They have bringing the manufacturing sectors to a stage where in not just giving the benefit of normal, I would say, a level playing field with the imports, but at the same time, they're also encouraging them to do the exports. And with the exports, what they are trying to do is giving more and more incentives to the exports. And there is one scheme which is quite good, is movers policy, where they are trying to give benefit to the exports, the companies who are doing the exports or who are going to do the exports, and instead of creating a separate divisions within their companies like domestic tariff or the export oriented unit or SCZ. So these are the benefits which they have been giving, and of course the going forward also, the objective of the government would be more towards manufacturing in India. There will be definitely a thrust. So any client of ours or any companies or this, they do look for joint ventures, etc., with the foreign companies, with the objective that the more and more manufacturing should take place in India. As far as valuation of goods is concerned, section 14, they have made an amendment. The new subsection which has been inserted section 14 and 3I clause. Section 14 has been amended to include provisions for rules enabling the board to specify additional obligations of the importer in respect of class of imports whose value is not being declared correctly, the criteria of selection of such goods, and the checks in respect of such goods. This amendment is a measure to address the issue of undervaluation in imports. Then there are definitions also where they have introduced some definitions and they have made some changes in this. As far as application when advance ruling is concerned, Section 28H is being amended to make provisions for prescribing appropriate fees by the board relating to application for advance ruling, and also give flexibility to the applicant to withdraw his application at any time before a ruling is pronounced from the current 30 days time period. And those are the major provisions, and there has been some other provision consequent of provisions like cognizance of offenses and validation of certain actions taken under the Customs Act, that there has been change. And they have also, with effect from May 1, 2022, they have amended in a manner specified in the third schedule to the Finance Bill 2022 with the view to harmonize certain entries with harmonized system of nomenclature to create new tariff lines in respect of those entries and to revise the rates in respect of certain tariff items. Basically, it is to synchronize the harmonized rates which was there. There was a difference of harmonized rate between what was manufactured or under what entry this was considered in India, and then it was there globally. So that's it in the customs. So Archana, any other point which is left?
So Nidhi, I think you have taken care of everything from the canon judgment, which is going to be a big impact because many litigation was upheld and many show causes were quashed because of this provision where they don't had the authority. So now they have amended the provision and now they have made them proper officer. So it is going to wake up many sleeping kind of litigation that were a bit dormant at that point of time, but now it will be again taken care of. And yes, some of the provision has been changed with in sync with the Atmanirbhar Bharat policy. So they are making that make local vocal, so that people are more motivated to get into manufacturing. And this is the thing they have taken care under customs notifications, where they have made these kind of amendments, and some benefits has been withdrawn, so that level playing field is given to the local person also.
So Arjuna, I have a question here. So is this Canon India judgment has been given a retrospective effect? And what about all the cases which are still pending before various forums on the similar issue?
What I feel is, whatever it may be, now the officers are geared up. Now at least they have some kind of legal backing. So if today it is not retrospectively amended, tomorrow they may amend it retrospectively also, because now they have made the provision. So
Okay.
they may come up with a retrospective amendment or some kind of new date of notifying this new definition.
Okay.
Definitely, this is not a good thing for the assessees where the litigation was pending.
Great. Thank you.
So any questions? I don't see any questions in the chat box. So anything that has been directly posted to BRICS forum, Ankita or Suzanne?
We can also take up questions regarding the direct tax.
There was just one question that was there. Impact of disinvestment in stakes of Air India by government.
That is with respect to disinvestment.
Yeah. So impact of disinvestment in stakes of Air India by government is that definitely there will be a public investment which may also come at the moment. That's what is expected, and it is also going to overcome the issues of NPS, etc. with Air India. So I think majorly it's an investors who are going to come or expected to come to be part of this when it gets privatized. Even in LIC also there is a disinvestment or there is a public listing which is going to happen. So the expectation is that it is going to be ultimately it's a monetizing various companies for the government. The impact is more for the government.
I would like to clarify one thing, that for the purpose of disinvestment of the Air India, government has amended the section 79 of the Income Tax Act, which gives that if there is a strategic investment in the public sector unit here, able to take the carry forward of the losses here. Earlier section 75 was not allowing this type of losses if there is a change in the management here. But this as a leeway has been created under section 79 of the Income Tax Act, where the such type of disinvestment has been facilitated by way of carry forward of the losses by the under the Income Tax Act. This is a very good development, particularly for the PSU who are going to be under the disinvestment here. Like now, Air India is there. Neelanchal Ispat is on the right now is about to be transferred to the private sector here. These two is particularly in the February itself, Neelanchal will transfer. So there's a big boost to all this disinvestment which is going, and I hope that with this type of provision, many other investors will come for this type of or takeover of these PSUs here, which are the Sikh PSU.
And apart from that, they have also done, I would say, not say a privatization, but then there is ordinance factory boards also. They have made separate as public sector enterprises instead of being just the ordinance factory board. So completely owned by the government. So that's also they have privatized from 1st of November, and which of course may not have an impact from income tax point of view, but which may definitely have an impact on the industry as a whole.
One more clarification that I would like to give, that RBI Act has been amended to include the money, the virtual currency as a money into the RBI Act here.
This is with regard to the virtual rupee which they're going to introduce.
Yes.
But I feel Prakash, that whatever happens, but it is at least it's times where there has been thrust has now been going towards more towards the new monetization and of course investment point of view and public private investment point of view, not just with the tax administration or tax collections and all. So the thrust has been actually shifted, and litigations are of course have been reduced, and there has been more focus on the sectors. So as we all maybe are, I think whoever are the participant, they are mostly consultants and professionals in this particular profession in this area. So I would still suggest that it's good to have the major impacts on the various sectors where you are working currently, and where you could give more value add to the companies or to the clients, and the changes which are required in their particular areas. So that would be really helpful to the industry. And any suggestions you have with respect to the budget and anything, you can always send it to BRICS, and then we can take it forward to the government. Over to you, Ankita.
I'll request you only, Nidhi, for a vote of thanks.
Yeah, thank you very much, everybody. And I would first like to thank participants for participating till the whole session, and please feel free to send your queries or any pain points to the BRICS team, and they will take it forward. Or otherwise, if you have any questions from us, so please feel free to reach out to us as well. And thank you very much, Prakash, that I'm hoping that you will be part of us very soon. And it's really good to be, and very, very good interaction between you and Pranshu. And I love this, the corporate tax and income tax area, as you know.
Yes.
Yeah.
Yes.
And Ankita has taken me in the indirect tax because Pranshu was there. So anyways, thank you so much. And thank you, Archana, being very, very supportive. Sarthak, always there, supportive. And Saurabh is a new ad, and it's really, really very good. And I'm very happy to see 6 of us being part of in the BRICS chamber. Thank you so much.
Thank you.